Hello guys, and welcome back to the channel for a new video. You know, Cathie Woods is in trouble. Her second biggest investment was Teladoc, and this stock reported earnings, and clearly they need to see a doctor, a mental health doctor actually. They have crashed so much after earnings, it's ridiculous. They went from being Cathie Woods' second biggest position to her fifth biggest position. As someone who really likes long-term investing, I thought I would look at this stock, and I must say that I was very negative, but I wanted to do a model of what I think, what is the valuation now, and what can we hope for the future. And I was very interestingly surprised. So I want to share this table with you, and of course, as always, this table is going to be available on our Patreon, and it's $5 a month. If you want to support the channel, it would be amazing. And if you like this video, then please make sure you subscribe. So as a pretext to the video, as you can see, this is the infamous day when they reported earnings, and they fell 40% on that day. And they are supposed to be a growth stock, one of Cathie Wood's best investments. However, they are down almost 90%. Oh my god, the pain she must feel. So the question is, when something is down this much, did Cathie Wood mess up completely, or is the market missing something? And very interesting. I really admire this from Cathie Wood, that she's in a lot of trouble, and as you can see, she is still buying the stock even after it has plunged 50%. So as I said, I started assembling, I listened to their earnings call, I read their investor presentation, I started putting together a table that shows what the stock is doing, and I must say that this stock is a bit tricky to evaluate because they're not a money-making stock. Part of the reason why they fell this much is because a goodwill impairment, meaning that they had an item in their bookkeeping because they bought another company. That company is not performing as well as they thought, so therefore they readjusted the valuation of that company in their bookkeeping, and this adjustment causes a 6 billion loss in their bookkeeping, which is horrible. But this is, you have to understand that this is not an actual money loss, this is a paper loss in the bookkeeping. And I've heard a lot of viewpoints on this, and you know, of course, one viewpoint is, how competent do you think that management is if they bought a company for 18 billion about a year ago, and now Teladoc and this company together is worth 5 billion. But in their defense, every stock and growth company is down about 90%. So it's not necessarily management's bad decision. For sure, it maybe wasn't the best decision to merge with this company, but every stock price has been decimated since the point that they bought this, right? So currently we have a stock price of $36.06. We have a market cap of 5.8 billion. So we don't have a PE, right? The only thing that we have is a price to sales ratio, which is 2.88. This is a very attractive valuation just from price to sale. And then it's very interesting because when you look at their financial statements, they do show that they have free cash flow. And I added it here. So they start in 2018, they start with 13 million negative cash flow, and then in 2019 they go positive, and then they go negative 2020, and then they go positive in 2021, 130 million. So sometimes I'm a very big Palantir investor, and Palantir is in a little bit of a similar situation because they also don't have a profit, but they have a very big and nice free cash flow, and then they have a very high stock-based compensation, which also puts the bookkeeping into minus. And you can model the company with like taking away the stock-based compensation and looking at the free cash flow. And I thought, if we can do this with Palantir, why not also do this with Teladoc? So basically the PE-ish figure, if you look at it on the free cash flow, that's a 45 PE. I mean, again, this is not PE. And then I found in their investor presentation a table that they make themselves. It's here. When they adjust the EBITDA, because they also have stock-based compensation, they also have, you know, many other items that don't really reflect how the business is actually doing. And when you don't have this crazy loss from the goodwill impairment, and you know, your stock-based compensation is less, and there's, you know, certain one-time costs of buying companies are not counted in, then this is what the business would be producing. So they would have a profit margin of 12.5, 13.3, 12.9, 13.9, This is quarter by quarter, right? And then they said in the conference call that they really have higher customer acquisition cost, and this is hurting their margin in this Q1. But what's very interesting is they give the numbers here, and then you can add them up, and then you have the adjusted EBITDA for the whole year. And I did this math for you. So basically, if you do this accounting wizardry, which you're not really supposed to do, again, I'm only doing this to get an idea of their valuation, then they suddenly have a PE of 22. This year they're guiding for a 20% growth in revenue, which would put their PAG ratio, meaning the PE as compared to their growth, it's at a 1.1, which is crazy undervalued. The 22 PE, again, this is accounting wizardry, again, very undervalued. Price to sales, again, very undervalued. So based on these numbers, the stock looks very, very undervalued, but this is just half the story, because what's important is what happens in the future with this stock, right? And again, here we come again back to that it's very hard to value, because I was looking for any guidance from management. They do not give guidance, and they basically gave a bunch of troubling news with the company. And what they said in the earnings call is that they're going to reevaluate and come back with the guidance after 2022. Meaning investors don't have anything to think with, and when investors have uncertainty, then they basically go to the worst case scenario. So I started looking at, okay, let's say that they're growing 20% per year. So you can see I edited, these are the years, I went up to 2030, they're growing 20% per year. And then they already guided for a lower operating margin this year. And then, you have this operating income. Again, this is with the accounting wizardry. So, you take out the non-cash items and, again, this is done to get an idea of the valuation of the stock. Then I have the share count, and I basically, the way I did this is I divided the market cap with their current share price, and then I rounded it up to the next number to get an idea. So they have 162,500,000 shares, and I decided to count with 3% dilution per year, which is on the high end but still normal for companies. So the interesting thing is that with this very simple calculation, you can see that in 2025 they will have 5 million and basically over 500 million in profit, again accounting wizardry, and they will have over 1 billion profit in 2030. Now if you take a PAG ratio of 2, which is not unreasonable but is on the higher end, then if their growth is 20%, then the PE would have to be 40 PE. So then in 2025, you would get a market cap of 20 billion for this company. And in 2030, you would get a market cap of 50 billion. Now that is compared to the current market cap, which is 5.8 billion, almost a 10x in 10 years. So that's pretty good, right? And the very interesting thing is, again, I had to do some accounting wizardry to get to these numbers. But the growth, if you look at their historic growth, okay, so between 2018 and 19, they grew 32%. Then between 19 and 20, 98%. Then from 2020 to 2021, they grew 86%. And now their growth has collapsed, right? So if they are able to come back to any sort of growth, then this calculation is a wrong calculation. So if they're able to go back to 30, 40% per year, then this table is way undercounting the potential in this company, okay? And it's really weird because I may be biased on this company. I live in Sweden, right? I have kids, and there is a Swedish version of Teladoc, which is called Kry. And I use it with my kids all the time because it's so much more comfortable than actually going to the hospital with your kids. And I just cannot see that in the future, if I look 10 years from now, that people will be opting out from easily reaching their doctor, not having to drive with their kids into a hospital where you have to sit with other sick people, where you can catch a disease, or your kid can catch something from someone else, and you can just sit at home, the kid can be comforted, and you can speak to a doctor. And obviously they cannot help with every situation, because if your kid needs surgery, obviously they can't do it on the phone. But I cannot see that For sure, they have gotten a very big boost from COVID, but I can't see that people would want to go back to traveling to the hospital, sitting in the waiting rooms, the healthcare taking a lot of time, and it's very uncomfortable with the kids. So I don't believe that this is the future. The very, very interesting thing is, if it's true that the market cap is going to be 20 billion and 50 billion in 2025 and 2030, then the stock price will be $111 in 2025 and $237 in 2030. So now the big question is, should you buy the stock? So again, for you to believe in this calculation, you can download this on Patreon and play with it yourself. You're basically believing that Teladoc is going to be the future. They're going to be able to be growing with 20% per year. There are a lot of people on Wall Street who are saying that people will go back to, physically seeing their doctors. I just, again, can't see that. So this is where you can be wrong, very wrong. And also the future P of the company can be very off both ways, because if their growth re-accelerates, a 50, 60, 70p even would not be unjustified for the stock. And if you see I change the P, you immediately get a 166, like a 50% higher stock price. Then I made this really interesting thing here of, you can write in the return that you want to have, and then this program discounts the future price into what that price would mean today. So if you believe in this calculation, which I think is very conservative, but I'm not satisfied, I want to do more research on Teladoc, then $39 a share is a fair price, so that you get compounded 30% return every year, and on a 10-year span, $22, right? If the P is 60 and their growth is different, then even $58, you would get a 30% compounded. So if you buy it for 58%, you get a compounded return of 30%. And this is most probably what Cathie Woods is thinking with, right? So I'm just going to play with the number here. Yeah, so you can possibly get, if the P is 60 and they re-accelerate the growth, you can possibly get a compounded return of 50% every year at the stock price, at the current stock price. However, there is one troubling thing that I do want to take up on this company, and that is that I don't like their balance sheet, and I want to show you what I mean. So basically they have $839 million in cash in the bank, and that's very nice. However, their debt on the balance sheet is 1.5 billion, meaning 2 times the cash they have in debt. And they're not always cash flow positive. So for example, here they are guiding for that they will lose 32 million from their cash. I'm sorry, that they lost 32 million from their cash. But as you can see in my calculation, they're not a cash flow positive every year. And very easily, if things don't work out for them, they can get into a situation that they need to raise debt, which, because they have a lot of debt, it will be very expensive, or they need to raise equity, and with their stock being in the gutter right now, it's going to really, really dilute and hurt shareholders. So this is a very big risk that I would really pay attention to before buying this stock. However, based on these calculations, again, I want to do way more research on this company. Cathie Wood might be onto something, and the market might be missing this. Make sure you do your own research. This is not investment advice, but I hope I gave you a good idea about this stock. So thank you for watching if you have been this far, and I will see you in the next video. Bye bye.